What's up, everybody? Okay, so what we're going to talk about today is the appropriate and successful use of stop losses when trading consolidation. This is very important. Consolidation is a very good trading strategy to use. It's a very good trading setup. It's a setup that I use regularly. Consolidation, especially when you start to put it together with back testing, with proper risk management, which stop losses are part of, it can become a very powerful yet very simple trading strategy. So let's get right to it. How do we use stop losses when we're talking about consolidation? Well, first, we all know what consolidation is. If you don't, there's a lesson on it. Let's grab a line. All right, so consolidation is something like this. Really need to change the color of the lines here, you guys. Black on white is kind of boring. But all right, let's make this more fun. What color can we get? Let's do like blue. Right? Okay. So when we, oh man, I'm messing this whole video up. Whatever. Okay, so consolidation. Is that going to bother you guys? The one's blue and one's black. Does that bother you? Does that bother you? Does that affect your OCD? Does that bother you? Because if it does, I'm sorry. Okay, so consolidation. When we have a stock price that does something like this, right? And what are we looking for? We're looking for that break of consolidation, right? We want to see the break of consolidation, right? Now, that'd be nice if that happened, but usually that's not what happens. Usually what happens is we get a break and we get one of two things. We either get a retest and then a re-break, which is a great scenario, right? You get something like that. Or, wow, this line's really going to bother me. I'm saying that you guys have OCD, I have OCD. Or what we get is, so we either get a break, retest, and continuation, which is perfect case scenario. Or what we get is a false breakout. That can also happen. So we see this consolidation pattern lining up. False breakout, we enter short, get stopped out. So how do we use stop losses to appropriately manage risk? Well, our stop losses would be somewhere around here, right? Why? Well, because if a stock comes out of the consolidation range and then goes back into the consolidation range, our setup has been invalidated. This would be your stop loss. Okay? Now, here's the thing, you guys. If you do this, and you do this consistently, you can make money trading just this one pattern, consolidation. You can make money. The problem is people don't stop themselves out. What they do is they put a mental stop right here, and they say, oh, if the stock retraces to that point, I'll get out. So the stock continues down. They say, okay, if the stock retraces here, then I'll get out. But what actually happens is, the stock comes in and they say, it just barely comes in. It's probably just a retest and it's going to continue short. And then the stock, before you know it, is already up here and it's bouncing off the top again. Okay? You have to, I can teach you stop losses. I can teach you risk management. I can teach you scale outs. But if you don't actually implement the things, it's pointless. At the end of the day, Everything in trading relies on yourself. You have to take responsibility for yourself and for your actions. And if you don't use stop losses, well, you're completely eliminating the whole risk management part of trading, which is very important. Okay? So what happens? So let's say it breaks, we get stopped out, right? And then what if it continues lower? What if now it does this? What do we do? Simple. We just re-enter right here. No big deal. We enter right here. Or, if you want to be more safe, you enter right here. That's all it is. It's nothing crazy. No, what happens if this happens? And see, this is where people start to lose it. This is where people start to lose their minds. So what happens if this happens? What happens if we get that break, right? Get that second break. So you enter, you get stopped out, you re-enter. Guess what? Now this happens. Are you going to be able to stop yourself out again? Because your stop loss shouldn't change. Your stop loss should not change. When it re-enters the consolidation range, you should stop yourself out. Are you going to be able to do that? Or are you going to say, oh man, that's the second time I got stopped out? I'm just going to hold this time. You know, it'll probably stop it here at the high, right? And then when it gets there, it's going to blow right past it. And then you're going to say, oh man. And then you're going to say, well, I mean, it's almost to the top. So if it breaks to the upside, well, yeah, at that point, then you have your stop all the way up there. So this is what happens to most traders. This is why most traders don't make money. And it sounds so simple, like, oh, well, I just need to fix that, and then, you know, as long as I'm disciplined, I'll make money. Yeah, but you guys, it's a lot harder than it sounds. When you're playing with live money, when your money's on the line, it's a lot harder. If you can conquer this and you can use stop losses where they need to be always, you'll be very successful in trading. If you can do this. Because what actually happens in trading a lot of the times, so this is what actually happens. So trading's not perfect. No matter what anybody tells you, you know, people will say, yeah, you just trade the strategy and you're good to go. No. What actually tends to happen in trading, right, is you get something like this. You get something where you may be stopped out once, twice. You might get, let's go another little right here. You might get stopped out again. Okay, does this matter? It depends. Usually with consolidation, when it finally breaks, you do get a move to the downside that's quite large. So this is what I'm saying. This your risk that you're taking here, you get stopped out once, stopped out again, stopped out a third time. You add up all these little losses, it does not matter. As long as the profits that you finally take, as long as these profits here that you finally take, let's say your profit level is down here. And we'll get more into depth because you can use this combined with like whole number support, whole number resistance, and you can really truly get a pretty powerful trading strategy. But let's say, so that's where your targets are, right? So you exit here for whatever reason. If that maybe, you know, what I always say is you need to look to the left of your chart, look that way to see where the other support or other resistance is. So let's say this is a level where there is support zone where it might bounce to the upside, right? So this is where you want to put your, let's say, your exits. These little losses that you took right here, if you add these 3 losses together, I assure you that this amount of profit here is going to cover those losses and make you money. But this is where people struggle. They're shown the patterns. They're shown the consolidation, triangle breakouts, head and shoulders, bear flags, bull flags, all these different patterns that, if back tested, do pretty well. They're shown these patterns. This right here, this area right here, this is where people struggle. That area right there. Because people do not know how to take losses, and then enter. So what actually happens is you say, screw this, and you don't take the trade. That's what actually happens. So you get stopped out once, stopped out again, stopped out a third time, and you say, screw this isn't working. And you stop trading, and guess what? That fourth one, the one that you didn't take, that's the one that's going to make you money. That's the one that's going to cover your losses and make you money. It's just the honest truth, you guys. This is where people get stuck. Okay, so let's move it on to some real charts. Okay, so we're looking at Bank of America. We have a successful trade in Bank of America that I took, and then an unsuccessful trade in Bank of America that I took. Okay, these lines here, this is consolidation. This is consolidation. Okay, let's get rid of this to make the chart a little less annoying. What do we have here? This is beautiful consolidation. High, puts in a low. 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 Look at where my lows are and my highs are. This really should be like right around here. Okay, they're not at the tails. They're at the candlestick, and I would suggest doing the same. Trade the candlesticks, not the tails. And of course, you're not going to be perfect. There's a little bit of struggle right here. But this is beautiful consolidation. Okay, beautiful consolidation. So what do we get? We get a break right here, right? What happens? So break and close right here. This break and close right here. What happens on this candlestick? Well, this candlestick retraces back into consolidation, but it does not close in consolidation. And if we're trading the daily chart, I suggest trading day closes. Day closes. Now, of course, you can't trade the exact close, but trade very, very close to the day close. The last 5 minutes. If we're trading the daily. If we're trading hourly, then you trade hourly close. Okay? What happened? Zero pain here. You enter in this candlestick here. Experience so maybe like a 20 cent, 30 cent loss right here. You don't get stopped out. Because at this point you're most likely using day closes. That's a whole nother subject. Now that's saying, well, now you have to use mental stop losses instead of automated stop losses. And I always advocate automated stop losses for the new trader. But when you're trading the day chart, you probably want to use day closes, which means that you have to use mental stops. What do mental stops mean? There's another lesson on that. Watch that lesson. Okay? But really zero pain here. Enter here, beautiful trade to the downside. Beautiful trade to the downside. And look how perfect this level holds. Get a double top right here. Because of this consolidation area. You get a double top. This would have been another good trade. Puts the first top, puts the second top, enter short. Another great trade right there. Okay? So that's a perfect case scenario. This is a trade that I traded, perfect case scenario. Here's one that I traded recently, not so great. Of course, this consolidation is a little bit weaker as well. But I see I see two areas of consolidation. I see right here. So I see this consolidation range right here, and then there's another consolidation range right here, right? But in reality, this is not a perfect setup. Reason being is you have this that's kind of sticking out here, protruding quite a bit outside of the consolidation range, kind of invalidating it. But what happened? So I entered long. So I entered long here. Whoops. Entered long here at the close of this one. Got stopped out. Re-entered long here. Got stopped out again. Okay. What did I do? Easy. I exited both times immediately. I didn't let my emotions get to me. Bad trade, bad trade. Was this my fault? Maybe. Maybe I should have been more mindful of this up here. So was this my fault? Yeah, probably my fault. Not the greatest setup. But what keeps me profitable, even if I'm not trading the greatest setups, is my discipline. Enter long, stop out. Re-enter long, stop out again. Simple. Simple. Re-entered long here. I was in profits for maybe 30, 40 cents, but I'm not after 34 cents. I'm after $2 or $3 on Bank of America. Because Bank of America tends to swing, look, 22 to 24. I'm looking for that $2, $3 move. Just in the consolidation range, it's swinging $2. If you look outside the consolidation range, it's swinging. We're getting moves from 15 to 21. It's a $6 move. So I'm not after this 30, 40 cent gain. I'm okay taking the stop for what's that? For 40 cents the first time, and so 32, 26, so around 50 cents total loss right here. Guess what? If this continues downward, breaks the bottom. So if this continues in this direction, right, breaks and continues lower, all I need to do is 40 cents, 50 cents to cover my losses. Anything above that, profit. What if it does the opposite? What if instead it goes to the upside? So instead it moves and it breaks and it re-breaks and moves to the upside. Guess what? Again, all I need to do, here's the break. Now I covered losses. Anything above that is profit. It's okay to take those losses as long as you keep them small. I can take 30, 40 cent losses all day long. Even if I'm swinging, let's say I'm swinging 1,000 shares. In a perfect world, I would like to trade 1,000 shares on everything. So let's say I'm swinging 1,000 shares. Those 20, 30 cent losses are $200, $300 losses. I can do that all day long. Zero effect on my emotion. Because I know eventually when this breaks, and I get a move like this over here, 15 all the way down to 10, that's $5 on 1,000 shares. It's a $5,000 move, right? Or what about the break on the upside right here? 18 all the way to 22 bucks. It's a $4,000 move. So I can take 20, 30 cent losses all day long. And it works the same if you have a smaller account. Let's say you're trading 100 shares. Okay, well, for a $5 move, that's $500. 30-cent move, that's $30, $40. I can take those all day long. I can keep taking those, zero emotion. But that's where most people struggle. They see a $40 loss and then another $40 loss and then another $40 loss and then another $40 loss. Or if you're trading like me with, let's say you're trading, let's say a bigger sized account. Let's say you're trading 1,000 shares. That's $300, $400, $300, $400. That drives people nuts. I can sit here and do this all day long. Keep pulling the trigger, keep pulling the trigger, keep pulling the trigger. Can you? That's what's going to make the difference between a professional trader and an amateur trader. Can you trust your strategy? I can keep pulling the trigger all day long because I'm disciplined. I know that eventually this is going to break and it's eventually going to cover my losses. Not only that, I diversify. I'm not just trading Bank of America. I have 6 or 7 or 8 stocks always active in my portfolio that I'm trading, that I'm not investing in. I'm talking trading. I have about 6 or 7 active open positions. I'm a swing trader, so I don't have to manage all of them all the time. But every day I manage about 8 or 9. Really, it's anywhere between 5 to 10 positions. Right now, I think it's around 7. So even if I keep taking losses here, taking losses, my other stocks in my portfolio, they're kind of balancing out those losses with gains. That's why diversification, even in trading, is very important. Okay? But even if I were just trading Bank of America, I know that over the long term, statistically, consolidation ranges have an edge. They have an edge over the market. If they have an edge, what do? I trade them every single time they show up. This could go like this. We could literally see something like this. We could see a rebreak and then me enter. And then we could see a breakdown again, get stopped out. I could do this. I could keep doing this. I am not going to stop doing this. We could do this. We can do this 3 or 4 more times. I do not care. We can keep breaking up and down. Let's say it goes to here, breaks here, right? Breaks up, right? I can keep doing this, you guys. Why? Because I know eventually what's going to happen. Eventually. What's going to happen. This is eventually going to go in my direction. This is eventually going to break down like this. Okay? All that I need is, let's see here, where's my rectangles? All that I need this, okay? I need that to be less than the couple of losses that I take here. So I enter long here, maybe get stopped out there, something like that. Even if I do this and I take 3 little losses, right? All I need these losses to be less. If you add them up, I need these losses to be less than my total gains. That's it. So I could take many more of these. Right? I can keep taking these losses. Keep taking these little losses. Keep taking them. If I could grab them, that'd be nice. I can keep taking these losses. Why? Because look how many I can take and still be in profit. All I need is for this profit amount to cover those losses and, of course, commission. But when you're trading with a larger share size, commission is not too big of a deal. If you're trading with 50 or 100 shares, yeah, you have to take into account commission. But if you're trading with 500 or 1,000 shares, commission is not too big of a deal. This right here, this is why I'm profitable. And I trade a little bit differently than other people. Other people, usually they have higher accuracy. So their strategies are more accurate than mine. They might be 60%, 70% accurate, but their win to loss is about 1 to 2. So that means for them, their win to loss amount, every time they win $1, their loss amount might be $2. So how are they successful in the markets? They're successful because if they're accurate 7 out of 10 times, and they win $2, that's 2 times 7, that's 14, and they lose 3 times, 30% wrong, that's 3 times 1, that's $3, so they pocket 11. How do I stay profitable? I'm on the other side of the coin. I trade a little bit differently. I like setups that are going to give me large moves. I look for those large moves. So really my risk to reward is probably if I lose $1, I'm going to win $6, $7, or $8. But my strategy is not as accurate. So instead of having a 60, 70, 80% accuracy rating, I have maybe a 30, 40 to 50% accuracy rating. So I'm wrong more than I'm right. But when I'm right, I make so much more money that it covers my losses. Okay? It just depends on your personality. I'm very disciplined. I can trade 5, 6 losses in a row. I don't care. I keep pulling the trigger. If you can't do that, you are going to need to develop a strategy that's more accurate, even if your win amount versus loss amount suffers. Which one do I think is better? I think trading with the higher win amount versus loss amount and a lower accuracy, I think it's way better. Way better. Way better. Now, what do we teach at Finance and Chocolate? We teach you the fundamentals. I'm not here to sell you some strategy because we're an education site. We're not a bullshit site. I'm not calling anybody out. Trust me, I'm not calling anybody out. I have a lot of respect for the real educators in this industry. I have a lot of respect. All I'm saying is I would prefer here at Finance and Chocolate to teach you the fundamentals, the core concepts, and then allow you over time to develop a strategy that works for your personality. I don't think cookie cutter strategies work because not everybody is the same. Your love in your life, your boyfriend, girlfriend, whatever. You get along with certain people, not everybody. I guarantee you, if you think in your mind, you could say there are some people that you could never date, that you could never be with, because they would drive you nuts. Yet they still have a boyfriend or girlfriend that's been with them for 5, 6 months or a year or 2 years or 10 years. Why? Because everybody has a different personality. Some personalities work better with different people, right? It's the same in trading. I can't give you a cookie cutter strategy and just say use this, because it'll work for some people and it won't work for others. Unfortunately, most people want that cookie cutter strategy because most people are lazy. They rather have that cookie cutter strategy even if in the long term it's not going to work and they're going to quit in a year, because at least for that year they have hope. Oh, I can't wait to make so much money. They don't realize that trading takes dedication, time, and effort. So what we teach here, we teach you the core fundamental concepts. Risk management, trade patterns that work, stop losses, scale outs. Core concepts that work across the board. It is up to you to tweak them, to make them work for your personality. All right, you guys. I hope that was informative. I hope that that helped clear up some both my opinions when it comes to stop losses, how I use them, and how you should use them. And I'll tell you this, you better be using stop losses. Do not be that guy or that girl who takes a 1,000 share position, thinks that they're going to make maybe $2. That's where their profit target is. And before you know it, they're $6 into a loss because they didn't use a stop loss. Don't be that guy or that girl. Okay? Losses are okay as long as they're managed and they're small. Keep them small. If not, you're not trading, you're gambling. If you're just throwing money at the market and it goes against you and then you just hold and it turns into an investment that you're going to hold for 5 years, hoping that it's going to eventually move to the upside or vice versa if you're short selling, no, it's not what we do here. It's not how we do it in trading. So use your stop losses. All right, you guys, I'll leave it there. Until the next lesson, like we always say, trade smart.